Have you ever dreamed of selling your products beyond your own borders? Taking your business global? It's an exciting thought, but let's be honest, it can also feel a little intimidating. Well, think of this as your practical starter guide to navigating the world of international trade for the very first time. Okay, picture this. An email just landed in your inbox. Boom. It's your first international order. The excitement is real, right? But then, so is that sudden rush of questions. Wait, how do I ship this? How do I make sure I get paid? What about all the forms and the paperwork? It can feel like a lot, but don't worry. We're going to turn that uncertainty into a confident, yes, I'm ready. So before we dive into the how-to, let's just zoom out for a second and talk about the why. I mean, with all these potential complications, what's the big idea here? What makes selling your stuff across the world not just possible, but actually a really good thing for everyone involved? Well, it all boils down to this really powerful economic idea called comparative advantage. It sounds complicated, but it's not. All it really means is that every country is good at making something. Some are great at growing coffee. Others are amazing at building electronics. The theory is, if each country just focuses on what it does best and trades for the rest, the entire global economy gets more efficient and everyone wins. That's the core reason your product might be in huge demand halfway across the planet. And when you start exporting, the benefits create this incredible ripple effect. I mean, for your business, it's obvious, a way bigger market. But for your home country, it's a huge deal. It brings in investment, it creates new jobs, and it strengthens the whole economy. Plus, when you have to compete globally, it forces everyone to innovate and get better, which is just a win for customers everywhere. Okay, so the why is pretty clear, but how do you, as a business owner, actually compete out there? Well, the key is understanding the rules of the game, and the most important rules are all about trade agreements. The single biggest wall you're going to run into when you try to sell your product in another country is something called a tariff. Think of it like an extra tax that a government slaps on imported goods. And what does it do? It instantly makes your product more expensive for the customers you're trying to reach. And this is where knowing the rules gives you a massive, massive edge. This is the power of a free trade agreement, or an FTA. Look at this. Without an FTA, that $20 tariff gets tacked on, making your product way more expensive. But with an FTA, that barrier can completely disappear. Suddenly, your product costs what it should, and you're way more competitive. It's a total game changer. And FTAs are really just one step on a whole ladder of countries working together. It starts out simple, with basic agreements to just lower a few tariffs here and there. But then it can grow all the way up to a full-blown economic union, kind of like the EU, where countries coordinate all sorts of policies. Just knowing this progression helps you see the bigger global picture. All right, so you found a buyer, you figured out the tariffs. Now we get to what is, for most people, the most important part. How do you make absolutely sure you get paid? When it comes to getting paid internationally, you've got two extremes. On one end, there's the open account. That's where you ship your goods and basically just cross your fingers and hope the buyer pays you. That's a huge risk for you, the seller. On the other end, you could ask for payment in advance. Great for you, but think about it. It's a massive risk for the buyer. They're just sending money to a stranger and hoping the goods show up. So the whole game is about finding that sweet spot, right? That trusted middle ground where the risk is taken out of the equation for both of you, so the deal is built on security, not just blind trust. And the solution, the most common method in all of international trade, is the letter of credit. We just call it an LC. The best way to think about it is like a secure escrow service. The buyer's bank makes a promise, a guarantee, that they will pay you, the seller. But, and this is the important part, they'll only pay you after you show them documents proving you've shipped the goods exactly as promised. It protects everyone. Okay, so the money is secured by the banks. That's a huge relief. Now we've got to sort out the actual shipping. Who is responsible for the goods? And at what exact moment does that responsibility and cost transfer from you to the buyer? This is where things can get really messy if you don't have clear rules. Thankfully, you don't have to invent the rules. There's a global rulebook called Incoterms. These are just a set of three-letter codes. You might have seen them, like FOB or CIF. They act as a universal language that spells out the exact point where the risk and the costs of the shipment transfer from the seller to the buyer. Using them prevents a world of headaches and arguments.
Let's just look at two really common examples to see how it works. If you agree to FOB, your job is done the second those goods are safely loaded onto the ship. From that point on, it's the buyer's problem. But with CIF, you're on the hook for more. You have to arrange and pay for the shipping and the insurance all the way to the destination port. See? Choosing the right Incoterm is a really key part of your negotiation. Okay, we are on the home stretch. The product is sold, the payment is secure, the shipping is all arranged. Now we just have to handle the final bits of admin, taxes and customs paperwork. Now check this out. This is a huge piece of good news for exporters in many countries, like Thailand. The value-added tax, or VAT, on goods you sell overseas is often 0%. $0. This is a massive incentive governments use to encourage exports, and it often means you can even claim back the VAT you paid on your supplies. But there's one last piece of information that is absolutely essential. Before your product can cross any border, anywhere in the world, it needs a kind of universal passport. It needs a unique code that tells every official exactly what it is. And this passport is called an HS code. It's basically a standardized set of numbers that classifies your product in a globally recognized system. It doesn't matter if you're shipping bananas or computer chips, the HS code lets a customs officer in any country know exactly what's in the box and what taxes or duties they need to apply. Getting this code right is absolutely critical. So let's put on our importer's hat for a second to see how customs officials use that code. First, they look at the total value of everything: the product, the insurance, the freight. That's the CIF value. Then, using your HS code, they apply the correct import duty, let's say it's 20%, and finally, VAT gets calculated on that new higher total. So as you can see, the final tax bill your customer has to pay can be pretty big. Understanding this helps you know the true cost for your buyer. So there you have it. From the big economic theory all the way down to the tiny detail of an HS code, you now have the starter kit for your first international sale. That first overseas order doesn't have to be intimidating. It's a massive opportunity. The only real question left is, where are you going